Is the economy heating up faster than expected? Can we expect inflation to heat up faster than expected? What is the Fed going to do next? What should investors do next? Adrian Day is going to break this down for us. He is the president of Adrian Day Asset Management and the portfolio manager of the Euro Pacific Gold Fund. Welcome back to the show, Adrian. Happy New Year.
Well, Happy New Year, David, to you and all your listeners.
A tremendous jobs report came out on Friday. The unemployment rate fell to 4.1%. Non-farm payrolls increased to 250 or by 256,000 rather in December, up a lot from the previous month and also higher than the median forecast of 155,000. And so the Fed's looking at this and perhaps they're thinking of pausing. Those were the statements made by several Fed members on Friday, including Austin Goolsbee, Chicago Fed president. What is your take on, first of all, the data that we got today? Is this top line jobs numbers indicative of a stronger economy in 2025, or is there more to look at under the hood?
Yeah, I mean, there's no question. This number was very strong, much stronger than people expected, as you say, and also significantly, in my view, most of those jobs, 220 something thousand, 223,000, were private sector jobs, and that's a bit of a change because one of the things I've talked about many times, including with you, is the fact that most of the new jobs are government and part time, and now we've got apparently 223,000 new private sector jobs. I will make a few points, if I may, to be the not the Debbie Downer, glass half full person. I mean, look, first of all, we've got a low labor participation rate. We've talked about that. It didn't change, but it's low. And, the average hourly work week is 34 hours. So that's across the board. That's not with the new jobs. That's 34 hours across the board. So most people are not working a 40-hour week. I think the other significant thing is continuing claims are up. Let's not forget that. So we're creating new jobs, but continuing claims are now at a 3-year high. It's taking people longer to find a new job. So when people quit or are fired, either one, it's taking 24 weeks on average to find a new job. And that's the longest since the beginning of 2022. Mm-hmm. But I think two other things are even more significant because, what I've said so far is maybe a little bit sort of nerdy or in the weeds. We look at the ADP jobs number yesterday, and ADP and the Bureau of Labor Statistics have been quite different for quite some time now. They used to be very similar, but they've been quite different for a while. But the ADP said 122,000 private sector jobs were added. The Bureau of Labor Statistics says 100,000 more than that, almost double. So something somewhere is not right. The ADP number was below last month and below expectations. And then lastly, I think the most important thing, David, and we talked about this before, is we're going to get revisions to this number. We know they are. We're going to get revisions. And the Bureau of Labor Statistics reports are becoming, in my view, less and less reliable. And it's not just my view. What's her name? Michelle Bowman, the Federal Reserve governor, earlier in the week, or yesterday, in fact, she said, let me quote it here, labor market reports have become increasingly difficult to interpret. I mean, I think that's absolutely true. So they're more unreliable in themselves. But on top of that, we know we're going to have revisions. And if you look at the last couple of years, go back to the January 2023, we've only had 3 months where there's been an upward revision. The rest have all been downward revision. So yeah. I don't think it's at all unrealistic or anything else, conspiracy or anything else, to think that we might get downward revisions to this number.
Well, absolutely. But and the other thing I wanted to bring to your attention is I'm just looking at this. Well, CNBC compiled this chart, but this is courtesy of the U.S. Bureau of Labor Statistics. If you look at the non-farm payrolls additions in the last 2 years or so, there looks to be some sort of seasonality factor involved. In the past, you've had jobs added the most in the Q4 or the beginning of Q1, right? January, and then February and January as well. So I don't know if this is just a winter thing.
Well, of course, certainly for December, you've got the additions of Christmas workers, people
Yeah.
hired Christmas, and I didn't see a breakdown. I'm sorry, but I didn't see a breakdown in BLS numbers for how many were holiday workers. I didn't see that, but clearly some were. But I think that table you just showed is interesting, David, because obviously 2022, beginning of 2022, we had a big spike in jobs, after the end of lockdown and COVID and all that. But, it's by no means, it's by no means steady, but it looks to me like a pretty downward move. And even if you take out that February 22, which is a peak, it still looks as though we're trending downwards, not upwards. Admittedly, the last couple of months have been strong, but let's wait for those revisions. That's what I would say. Let's wait for the revisions. You know. So yes, this is stronger than I thought.
Yeah.
And again, when you say generally about the economy being stronger, I keep coming back to this point. We talk about these long and variable lags, and we seem to have forgotten about that. We're all in so much of a hurry these days. But, the Fed started hiking in, what was it, March of 2023. That was the first hike. And the average lag time between the first rate hike and the onset of a recession is 27 months. We're not even there yet on average. And the fact that we had ultra excessively low rates, sorry, that's tautology, but ultra low rates for so long means that more and more individuals, households, corporations were able to refinance at low rates, which to me suggests that the lag from raising rates back in 22 and 23, we've forgotten about raising rates. The lag time is going to be even longer than average. So I don't think it's, let's just say this, I don't think it is abundantly clear and certain that we have escaped a recession. I'll put it that way.
What is interesting to me is the strength of the U.S. consumer. Retail sales have continued to go up. And you'll recall, Adrian, that consumer products for loans, credit cards, mortgages, those rates haven't followed the Fed funds rate as closely yet, meaning there's, like you say, there's a lag even with consumer products. Why are people spending money even though consumer rates haven't fallen very much yet?
No, absolutely. People are, but the strength of a consumer is surprising to me. A couple of points. So, I mean, as we know, it's an average, and averages can be deceptive. Yeah, averages can be
Yeah,
deceptive.
absolutely. There's always the rich pulling up the average, right? I mean,
Right.
there's the wealthy people propping up spending in the
Yeah,
economy. That's always been the case.
defaults. I mean, they shot up last month. Credit card defaults. So, but the defaults on loans are definitely moving up. Um, the amount of debt that was taken on this Christmas was very significant, but it was less than last year and less than 3 years ago. So, I think people are beginning to, a lot of the consumers are beginning to slow down.
Yes.
But yeah, I agree with your general thing your general thesis that consumers have been stronger perhaps than one might have expected them to be. Um, and the other thing you mentioned earlier, inflation. I mean, there's no question in my mind that inflation is beginning to pick up again. Just looking at the numbers for the last sort of 5 months, we've had, again, not every month higher, but it's been, the trend line would definitely be upwards. And you probably noticed in the University of Michigan Consumer Confidence Survey, inflation expectations are up meaningfully. I take those with a little bit of a pinch of salt because they broke it down. They broke it down by party affiliation, and which is interesting because the Democrat has flipped completely from thinking inflation was completely under control But now that Trump's coming in, they have their expectations have gone way down, and Republican expectations have gone up. I mean, have gone up.
Yes.
Democrats have gone up, and Republicans have gone down. But there's no question in my mind that inflation expectations generally are moving up, and among the Fed, we know this. Jerome Powell said it last month, and we saw it in the minutes that came out, whatever it was last week. The Fed members see that the risks to inflation are now significantly on the upside. So they haven't necessarily changed their outlook for the next 12 months, but in terms of where the risks are, they have changed those significantly.
I am just wondering why the markets reacted as negatively to today's jobs numbers as they did. Like you say, the inflation expectations may or may not have changed in the jobs report. I'll let you comment on that. But inflation expectations have been going up for quite some time. It's not like a new phenomenon that happened last night. And
Sure.
so, what would the markets react to? Either, it's a forward discounting mechanism. They're either expecting lower economic growth, or they're just expecting fewer rate cuts because of today's jobs numbers. Which is it? What's your interpretation?
I think they're definitely expecting fewer rate cuts. I mean, I think we can, absent something between now and the end of the month, we can take a rate cut in January off the table. And I mean, I
Yes.
think it was clear that Jerome Powell and the Fed, they were looking for a reason not to cut this month.
And I noticed this before because here's the Fed funds rate. I mentioned this on another one of my shows. They've only cut by what 100 basis points so far. And if you take a look at the last three cutting cycles, they've cut by at least 200 basis points. 200 in 2019, 500 in the Great Financial Crisis, 500, 600 basis points during the tech bubble, and then dot-com bust. Not much in 1996, but that wasn't a recession. And so the question is whether or not this is just a pause or a stop altogether.
Well, I think it's a pause. The Fed is really, I mean, the Fed's in a dilemma, and they've been in a dilemma for a long time, but the parameters, if you like, are getting narrower and narrower. The Fed, as I mentioned, clearly is concerned about upside risks to inflation. And Jerome Powell repeated several times that inflation was not down to where they wanted it. It was more stubborn than they thought it would be. And when the Fed, particularly Jerome Powell, has staked his reputation on the fact that we're going to get inflation under control, that's our number one goal because it affects everybody, and so on and so forth. With inflation, if inflation begins to tick back up, it's going to be difficult for them to ease suddenly, rapidly, and significantly. But having said that, you've got the other side of the equation. If the economy does slow, and not just that, but we've also got the funding problem of the U.S. government, which is something else. We've got a lot. I think is Stephanie Pomboy. Sorry,
Yes.
let me just see. 10 trillion maturing debt this year, and 4 trillion of that is longer-term notes. 6 trillion is bills. So she estimates an additional 80 billion of interest expense just from the maturing bills, not from any new issuances. And so, those are things that the Fed has to be considering on the opposite side of the equation. So if inflation, and it was really interesting to me that the last couple of weeks, Jerome Powell has mentioned yet another gauge of inflation, measure of inflation, the market-based core PCE, which apparently is showing inflation more under control than the core PCE.
Yeah.
And it seems to me that they are searching around for a measure that will show people that inflation is indeed under control. Sorry.
No, my apologies. Go ahead.
No, I'm just going to. They know, and I would certainly say myself that inflation is not where they want it to be, The last half year has been very, very stubborn. We've seen very little movement downwards.
If you take a look at the BLS inflation chart here with the breakdown, you can well, the last inflation report was dominated by shelter. Shelter remains high, as you know. Shelter is measured by owner's equivalent rent, which is a survey of what homeowners are charging for rent. We're expecting to charge for rent. That remains high. Energy is still in negative growth territory, right? Negative. It's less negative than previous months, but it's not. It's deflating. And other items are going either staying stable or going down. So it's really just shelter driving it up. I mean, what's your outlook going forward? Which of these components do you think will be most affected by economic growth and also the Trump tariffs that we haven't talked about yet?
Yeah, well, obviously things like shelter shouldn't be affected by Trump tariffs too much. And the problem is, as you say, and I understand this, these things are just so complex. But shelter, which is a major part of the CPI, in fact, if I'm not mistaken, I think it's the largest single component of the CPI, but certainly it's a major component. And yet it's something that is, I nearly said made up. I don't want to sound frivolous about it, but it is not something that is objective and scientific and observable. So that is a problem when that's your major component. But I think we're seeing a lot, and let's not forget wages. In the jobs report this morning, I think we had a wage rates up an annual average of 3% at a 3% rate, 3% annual rate. So wage rates are beginning to move up. That's going to have an impact really across the board.
Okay, well, let's move on to commodities, actually. Trump tariffs, input costs for everything, commodities being one of them, goods and services. Imported goods, not so much services. But do you think that base metals, commodities, all those things will be affected by tariffs if, let's say, protectionist measures are implemented and trade is a little bit more closed off?
Yeah, no, absolutely. I mean, we're already seeing, well, for various reasons, we're already seeing a whole bunch of commodities moving up in the last few days, last week, last few weeks. Natural gas, of course, oil is being dragged along. Copper is up in the last week. Lumber, of course, because of the horrible fires in Los Angeles. But we're seeing an increase in commodity prices. The threat of tariffs will want people who have near-term needs import now rather than wait for those tariffs to be imposed. And so that also puts upward pressure on commodities. There's no question that if tariffs are imposed, and there's so much discussion about it as to what they're going to put it on and who they're going to put it on. There was a new round of leaks from Trump advisors today. So it's not clear who and what is going to have tariffs imposed. But certainly tariffs generally are going to make commodity prices go up because we import so much of our commodities. But in the first stage. But if prices move up, then maybe demand for those products go down. So it's not a simple question that you put tariffs on and inflation moves up and everything else stays the same.
So ultimately, then, today's jobs numbers, did they change your investment outlook or priorities for 2025 at all?
Well, I mean, I should be saying yes, but no, not really. One of the things that's most interesting to me, David, or most significant, is that, here you had jobs much, much stronger than expected, as we've discussed, much stronger. And the odds of a rate cut in January going down even further than it was going into this meeting and the number of rate cuts and the speed of rate cuts in the next year going down, and yet gold is moving up. You
Hmm.
would expect, other things being equal, you would expect gold to fall meaningfully on a narrative of deferred and slower rate cuts. And yet it moved up, and it moved up significantly. What that tells me is that there is of buying, a lot of buying power for gold. And I've kind of made this point that all of the groups that were buying gold over the last 2 years, and the reasons they were buying gold, um, the reasons haven't gone away. You look at central banks, of course, which were the number one buyer of gold over the last 2 years. And when President Trump, or incoming President Trump, says that if people move away from the dollar, he's going to impose 100% tariffs on all of their goods. I don't know about you, David, but that doesn't make Brazil or South Africa say, "Oh, well, maybe we won't turn away from the dollar." If anything, it makes them want to speed up their purchases of gold, in my view. And we're seeing that the last couple of months' numbers from the World Gold Council actually had a reversal. We had a bit of a decline in gold purchasing in July, August, September, but it's reversed, and China's back in the market. So the
Okay.
reasons that people wanted to buy gold, I just said central banks, but the reasons people have been buying gold have not gone away, and if anything, have been reinforced.
The issue of gold. Let's talk about gold for just a bit now. So gold has been rising in tandem with stocks, and I've noticed this and mentioned this several times in my show already. If one were to just objectively look at the performance of gold versus stocks, actually, let's do that right now. And if one didn't have, let's say, a history of studying gold for many years, one might conclude that gold is another risk on play. I mean, just look at that correlation, Adrian. It just you keep going back. It started in 2022. It went down when gold. It went down when stocks went down in 2022, the bear market of 22, and then it followed the stock market up. I mean, maybe there's a third variable here that's creating this correlation. It's not causation here, but I wonder if gold is now just behaving as a risk on play. Is that what's happening?
I'm not sure that's what's happening. There's two additional factors. One factor, of course, is we must never forget this, the enormous excess liquidity that was pumped into the world's economies over the last 12 years. And that money has to go somewhere. So that money goes to gold, it goes to stocks, it goes to bonds, it goes to Bitcoin. Everything gets a bit of that liquidity. But I think the other factor is, we just mentioned central banks. So the people that have been driving gold for the last 2+ years, 2.5 years, the people have been driving gold's price. Number one, central banks. Number one and number two, Chinese consumers. That's more in the last 12, 15 months, not the last 2.5 years. But the people that have been driving gold have been buying gold not because the US stock market is or isn't going up, not even because the dollar is or isn't going up, not because of the inflation rate in the US or the unemployment rate in the US. They're not, those economic factors and market factors are not what's been driving the gold price. But I think what you're looking at is, um, those factors have been affecting U.S. buyers, and that's why U.S. buyers have been very, very, really quite weak in the gold price.
If one were to speculate where capital flows might end up in 2025, would they be towards more defensive assets or more risk on assets, or perhaps in cash, money market funds, while rates are still high?
Yeah, I mean, an awful lot depends. I don't want to I don't want to bug the question, but an awful lot depends, I think, on really how President Trump's first few months, first 6 months really play out. And that's not clear to me at all. But I think let's say absent things going a lot smoother than people are thinking, or some complete sort of crazy blow up. I can't help thinking that money is going to start rotating into more defensive, assets, into value-oriented stocks, into income-oriented stocks, but just generally more defensive.
Let's take a look at what happened during the last Trump presidency. There have been periods of volatility throughout 2017 and 2018, pullback here in 2018. This is when the Fed cut rates in 2019, and then pullback here in 2018. But more or less, there was the general direction of the stock market during his last presidency was up. Now, Adrian, there was volatility whenever he announced tariffs. Here's my theory for what may happen this time, Adrian, is that the markets may not be as sensitive to the implementation of tariffs this time for two reasons. One, last time it was new, so markets didn't like protectionism. This time, markets have priced that in. And keep in mind, Biden didn't remove most of these tariffs. He doubled down on some of them, if anything. And during Biden's presidency, we had a huge bull run in 2023. So I don't think that tariffs this time around are going to be very bearish for stocks as they progress. Do you agree or disagree?
Well, I partly agree. There's no question. You're absolutely right. And we need to remember this. When a thing is first introduced, there's much more of a shock value. It has a much greater impact. We kind of get used to it after a while. I think an awful lot depends on the form of tariffs and who they're on. And that we just don't know. I mean, if, for example, and President Trump is what's the word, threatening, I guess, or promising, if you like it, threatening to do a lot of this by executive action. If, the day after he's elected president, he were to say 100% tariffs on everything from all of the BRIC nations, I think that would be a disaster for the US economy. If he says we're going to, widen the tariffs on sensitive national security Chinese products, I don't think that would have much of an impact at all. So, and there's a huge amount of room between, just very, very targeted tariffs on national security that have national security. But, but start putting 20% tariffs on French wine and cheese. And, I think that would have an impact.
This is a piece of news that came out today. Trump seeks Putin meeting as Biden administration announced 11th hour aid package to Kiev. This came out today. President-elect Donald Trump floated the possibility of a meeting with Putin to end the bloody mess in Ukraine. He wants to meet, and we're setting it up, Trump said during a Thursday press conference. So let's assume that at some point in the next couple of months, there is an agreement reached to end the war in Ukraine. I'm not saying it will happen, and I don't know what the details of this deal may be, but let's assume, for the sake of argument, that it happens. What happens then to gold? What happens to stocks?
I don't think much happens to gold, frankly, or to stocks. I don't think much happens broadly because, geopolitical events don't really have a huge, lasting, long-term impact on the gold price. We've seen this over and over again. And If you look at when Russia first invaded Ukraine, gold was up strongly in the 6 weeks while they were massing their troops and tanks on the border, moved up a little bit more after they actually invaded. And within 6 weeks after the invasion, gold was right back to where it was before they started massing their troops. And that's a typical pattern for geopolitical issues. They tend not to have lasting impact on the price of gold.
So you don't think gold is currently pricing in a geopolitical risk premium that may disappear?
Look, there is a geopolitical risk premium. It's a positive, not a negative. I mean, a positive for gold, not a negative for gold.
Yes.
I just don't think it's a big factor. I just don't think it's a big factor. And again, to get to my fundamental point, the major buyers of gold Are central banks going to stop buying gold because there's a peace treaty in Ukraine? I don't
Hmm.
think so. And we certainly haven't seen, the rumors of it. We haven't seen the cease, I think it's true to say a little bit of easing of tension in the Middle East. That hasn't had any negative effect on the price of gold.
Okay, let's finish off then on gold stocks. Now into actually let's take a look at the Russell versus 2000 Russell versus the SV. I'm going somewhere with this. You can see that over the last couple of years, 5 years even, the outperformance of the large caps has been undisputed versus the small caps and mid caps. Have we witnessed a similar phenomenon within the gold space where the large caps, the Newmonts and the Barricks of the world outperform the juniors?
Well, Barrick has outperformed, unfortunately. But I get your point. Yeah,
Yeah.
yes, except that is normal in a new bull market for gold. And my thesis is that the last 2 years of central bank buying and Chinese consumer buying were simply a prelude, was simply an hors d'oeuvre, if you like, because the economic factors that generally are in place to start a gold bull market were not in place. So in my view, we've only just seen the beginning of that new gold bull market, when the Fed started cutting rates. And so in the beginning of a bull market, it's always the case that money goes first to the large miners and the large royalty companies. That's normal, and we shouldn't expect anything different this time. So, I think money will flow down. Let's not forget the gold stocks, the XAU. If you look at the XAU, it's up like 25% in the last 12 months.
Yeah. Yeah.
No, that's not chicken feed. It's certainly not the kind of leverage we expect on gold, but it's not chicken feed.
Well, when you see, speaking of Barrick, I'm just going to use them as an example since we brought it up. When you see a chart like this, Adrian, when the gold price went up 30% last year, 32% over the last 12 months, and the stock price of Barrick is down 10% in the same period, what do you do with that information? Do you rotate to the small caps, the juniors?
Well, I don't
Do
think
you
so.
double down on Barrick? Yeah.
No, I think people look and say, well, why is Barrick down when Agnico Eagle is up?
Yeah.
Why is Barrick down when the XAU is up? And there are clear reasons. Barrick has been under pressure, particularly from Mali, but other places as well. So I don't think that means let's not buy Barrick, let's buy Consolidated Moose Pasture instead. I
Mhm.
don't think that's the lesson. You know, the juniors, and of course there's intermediates and there's juniors and then
Yes.
there's explorers, but their day comes later on in the bull cycle.
So 2025, is that the later part of this bull cycle? Is that the time to get into the intermediates or not?
Into the intermediates probably, but not the juniors. No, again, I think this if we want to call it a traditional gold bull cycle, the
Yeah.
traditional gold bull cycle has only just begun. The last 2 years were a total anomaly, with gold
Okay.
going up when the dollar was strong, when the economy was strong, when the stocks were strong. That's a total anomaly.
So if the gold market bull rally is still in its infancy, are you then sticking to the large caps mostly?
Well, sticking, we're emphasizing, I would say, we're
Okay.
emphasizing large caps because they are the not only the first to move, but the surer to move at the beginning of a gold cycle. So sometime this year, we'll start increasing our exposure to the intermediates, to the more junior producers. But I think the real small caps is going to be at least another year before they all move. But I
Absolutely.
think one last thing, if I may, you mentioned Barrick, the one lesson from that is that we need to be increasingly selective, I think, in what we're buying. Agnico, for example, I mentioned, has done very, very well, and Barrick has done very poorly. Agnico is now the second largest by market cap, so larger market cap than Barrick.
Hmm.
So I think the lesson there is just to be a little more selective than perhaps we have been in the past with the big caps, and not, they're not all the same.
Very good, Adrian. Appreciate your insights. Thank you. Where can we learn more from you?
Oh, adrianday.com.
Okay, we'll put the link down below. Follow Adrian there. Appreciate it, Adrian. Take care.
Well, thank you very much and have a good weekend.
You as well, and thank you for watching. Don't forget to like and subscribe.